growing or buying a building for your business, we can help you. We are on your side, not on the side of the lender, but we do understand lenders. We have connections with lenders, and we try to hook you up with somebody that can really give you what you need. The goal of the panel today, I'll read it, is to demystify the process of accessing capital. Whether you're looking to start, grow, or expand your business, understanding the different financing options available, whether through traditional bank loans, SBA-backed financing, alternative lending sources, or community development programs, it's really crucial. Our panelists are going to share insights into what lenders look for, how to position yourself for funding success, and tips for navigating the process effectively. We encourage you to ask questions, take notes, make connections that help you take the steps forward to secure the funding that you need. And with that, we're going to get started. Could you put the next slide on? That.
I don't want to. While we wait, I just, as the director, I wanted to thank Willa tremendously for all of her efforts. Being a real value add to our center. So thank you, Willa, for putting this together. Thank you to the lenders who are here today. We really appreciate your time, and you're for our clients as well as we are. So we appreciate your time and efforts to be here. And of course, I'd like to thank everyone who's attending, because you never know where a conversation is going to go. You never know what you're going to learn. You know, talk to somebody and your particular situation in terms of your lending needs or future lending needs. And let's get ready to be able to get a yes from a lender. And that's one of those specialties.
Yes, good. So I'm going to go through everybody here, just give a brief overview of the company that you're with or the business that you work with. And what is your sweet spot as far as lending goes? What do people come to you for, and what can you do best? I'll start here with Leo, who is from Pursuit. Great. And probably a lot of people don't know what Pursuit means, so.
Well, thank you, Willa. Thank you, everyone. Thanks for being here this morning. My name is Leo Zhang with Pursuit. So I'll just give you a quick overview of Pursuit. We're a community-based lender. In fact, we've been around for 7 decades and counting. So as a community lender, we provide various loan programs. So anywhere from, I'm sure you've heard of SBA loans, through loans through the state, New York City, to our own Pursuit specific loans. So these loans, the range, we can go from anywhere from 10,000 all the way up to 5 million. And I think beyond that, we also provide the added support that business owners need in addition to funding. So that's who we are, what we're about, and certainly happy to give more details for the rest of you.
Awesome. Good morning, everyone. My name is LaDonna Simon. I'm with Lendistry. Lendistry is a CDFI, is national, been around for, we're actually celebrating our 10th year in November. It is a minority-led CDFI, one of the only ones that exists currently. I would say that our lending is anywhere from 25,000 to about 5 million. Sometimes we can participate and go a little larger than that. Our sweet spot is probably our express products, so anything under $350,000 for working capital or equipment. Although we do real estate, investment real estate, and everything else, our sweet spot is definitely in that working capital space. And we're known for, we're a fintech CDFI. So that means we're able to get our loans processed quicker. So typically loans close within 3 weeks, 4 weeks, which is what we're known for.
And I want to just, everybody know what a CDFI is? Because we always use that, the lingo. So just so you know, Pursuit is a CDC, right?
CDC, CDFI.
CDFI, which is a Community Development Corporation and a Community Development Financial Institution. So that's what those acronyms stand for.
And if we could just touch on that a little bit more, it just means like Leo mentioned, there's some programs, whether it's state programs that we offer to help folks, and we also do a lot of business in opportunity zones, so underserved communities that otherwise don't really have access to capital. We do a lot of work in those communities.
And Lendistry has an actual portal online that they have set up for the Small Business Development Center clients where you can apply, and and LaDonna here is our relationship manager, as is all these people are our connections. So we can actually follow your loan and make sure that you're getting, one-on-one attention, because sometimes online you kind of get lost and you're talking to chat bots and all that. So we have a real live person. So thank you for coming on.
Yes,
to co- to
absolutely.
be
I'm
here in
happy to be
person.
here.
Appreciate it. Okay.
Good morning, everyone. My name is Troy Diaz. I'm from the Small Business Administration. My role at the SBA is I get to work with these fine folks and their back office people on a daily basis. I'm the lead lender relations specialist. For most folks, I found that their first foray into the SBA world, unfortunately, has been through COVID. Disaster financing, which is something, one of many things that we offer. There's a misnomer out there, we'll probably get into this a little bit on the panel, that when you hear the term SBA loan, the funds are not coming from the Small Business Administration, right? They're coming from the folks up here, their institutions. What the SBA does is we provide a guarantee on that loan to the lender. Think of it like an insurance policy. In the unfortunate event that something goes wrong, that's when the SBA comes in, when the lender knocks on the door and says, hey, we have this loan that went bad. We'd like to, enforce our guarantee. As far as a sweet spot, I'll leave that to the lenders up here. Our flagship lending program is the 7A loan program. When you hear the term 7A, it's not just a loan. It's basically like an umbrella under which many loan programs reside. It's a fantastic option for those who are starting up businesses, who may have challenges getting traditional financing. I always say if you qualify traditionally, go that route. If not, then the bank is going to look to put you in an SBA product, which is going to provide some advantages that we can get into later today. So I look forward to answering questions, and I appreciate the opportunity. Thanks.
Thank you. Thank you.
Morning, I'm Michelle Sparian with M&T Bank. We are a conventional lender, located right on Long Island. My office is in Hop Hop. I'm trying to think. So with M&T Bank, we do everything from business loans, lines of credits, investment real estate, mortgages, owner occupied. We have an array of products that we offer. We do startups, acquisition, expansion loans. We partner with SBA. M&T is a preferred SBA lender as well. And I've had the opportunity to work with Pursuit on some of the 504 loans when it comes to commercial real estate. Had the opportunity to work with Troy here as well with SBA. I guess our sweet spot, I kind of just went through all the products, but our sweet spot would be our branches handle loans 5,000 up to 250,000. My space is 250,000 over, probably in the up to 5-7 million. But I do partner with branches when they need guidance and assistance on the smaller deals.
Thank you. And by the way, we track where our clients statewide get their funding. And for the past 5 years since I've been back, I'm the chair of the statewide lender relations committee. And M&T is the top lender in New York State. And part of that is the ability to do startup financing, which is a lot of what we see from our clients. So we're very happy to embrace you and have you here today. Thank you very much, Michelle.
I'm Rich Cassiano, North American Resource Capital. Started the company in 1995, do all facets of business lending. A lot of what I do is SBA guaranteed lending and some microloans. Reason is a lot of the transactions that I get are not any credits, they're bank to clients, other lender to clients. I work with SBA lenders that are local, out of the area, and also that are not banks, that are commercial lenders. They'll oftentimes do transactions either quicker or under different guidelines that some of the SBA lenders won't do. So my sweet spot is problem solving, figuring out the puzzle. Transactions come to me, trying to put the square peg in the round hole, and there's oftentimes a way to shape it so that you can get it to fit. It takes time, it takes effort, and that's where my personal service with them comes in.
Thank you.
Thank you for having me, Willett. Everyone, thank you for joining us today. My name is Nick Stabile, and I am the Vice President of Sales, the Accredited Group, also known as TAG, right here in Melville. Company's been around for 18 years, and we are a conduit between the merchant and the banks and the private banks that are doing financing for alternative lending space. Our sweet spot is going to be someone who needs money quickly. In a lot of cases where we can get funding within 24 to 48 hours. Capital, the capital injection for whether it be a quick project that they have or equipment financing. But we also do things that are more long-term, lines of credit, business lines of credit. And the kicker of it all is we are a direct lender on the mortgage side. So we also, for the small business owner who never thought they had an opportunity to own their own home, we can use your business revenue to get approved for a mortgage as well. And we're the direct lender on that side. So thank you for having me. I'm looking forward to answering any questions.
It's awesome. So we have quite a variety here. We have the people online and the community development kind of companies, as well as the traditional bank and alternative financing. Let's start with Nick, because that was interesting about being able to get a mortgage. You do outside of the box kind of loans that the traditional lenders don't do. Could you elaborate a little bit on that? And what kind of pricing would someone expect to get? You know, because we always hear, you know, loan sharks and it's going to be a really high rate. What do you find and how do you manage that expectation?
Yeah, so that's a very interesting point and question. Basically, the way it works is when we go to the marketplace and we bring your file to a lender, a lot of times you'll have tried the bank, the traditional bank, and, you know, have failed because of, not because your business doesn't have a great idea, not because you don't have a great future, but because your revenue and your bottom line may not match what their criteria is when they're doing their underwriting. There is a place for both, you know, both when you're running your business, but a lot of times they come to us because they cannot get that immediate cash flow or an immediate need that they might have, whether it be to get some inventory for seasonal products, or in a lot of cases, a construction company may need to bid on some projects and have cash in the bank in order to buy the materials to get that project started. Having a line of credit at their disposal can really put them in a position of strength when they go to the marketplace to bid on those jobs. So that's where we really shine, I think, is that they'll judge you based on your revenue, not necessarily your bottom line, when they're looking at your file. And a traditional bank is going to look at, are you profitable? What is the cash flow from that standpoint? And again, we really do fit perfectly with a traditional bank in that sometimes we'll see them graduate and go into a traditional type of product. And we work with the banks to get them those products as well. We work with Pursuit, a few other people up here, to help them when an opportunity arises that they don't need a more short-term loan.
That's a really good point, because when you're a startup, there's inherent risk for a lender to partner with you on whatever you're looking to do. That's why we work on business plans and financial projections and help you see the true picture of what you're looking to do. I always say there's a lot of romance when you start a business, right? It sounds wonderful. You're very excited, lots of passion. So we try to tamp that down a little bit and start looking at the actual numbers. How much is it going to cost you? And how much are you going to be looking for? And what's the reality of getting that funding based on your personal situation? Because when you're a startup, it's mostly personal, right? Because you don't have a business yet that has a historical point of view. So let me ask you, let's start with Leo here. What are the most common reasons that loan applications get denied in your experience?
Sure, yeah. So from my experience, typically I would say the number one reason why loans get declined has to do with cash flow. Okay, because lenders, typically speaking, they look at the cash flow of the business to make sure the business is generating enough revenue, enough income to make the underwriters feel comfortable, right, in providing additional financing for further growth in the business. I would say that's probably the main reason, cash flow. There's other reasons, maybe sometimes it's also a credit score. And I'm sure we'll get into that in a little bit as well. But I would say before you apply, you want to certainly look at your financials, see how the current state is. And, I also often get a lot of business owners that reach out to us, just for some added guidance, right? So to better prepare them. So that's also another be a good reason to reach out early, even if you're not fine yet.
I'll skip to Michelle. I'm gonna bounce around. Michelle, when you first apply, because you do a lot of startups and you ask for a personal financial statement,
Right.
what kind of things are you looking for from a startup point of view that would give the bank the appetite to do that kind of loan?
So when we're putting a package together, we're looking at personal financial statement, what personal assets they have. Do they have money in the bank? Where are they getting the money to start up this business? So we ask for an equity injection. So typically we want to see at least 10% of your proceeds going into a startup. So we look on personal financial statement of your personal assets. Do you own a home is an important one. How much debt you have. So we look at that as well. We're also looking at, for the package, to put a package together, we're looking at, tax returns. If you're purchasing a business, we're going to ask you for historicals. And that helps with, with Willa when they have to help with the business plan projections. It all goes hand in hand. But I would say ideally we're looking for, personal assets. It's hard when someone only has, we had someone recently that only had about $3,000 in the bank and was looking to buy a business. So that makes it a little challenging. And they didn't own anything.
Right, and that's a good point, because a lot of people buy businesses thinking the business is profitable, but they're not calculating what is it going to cost when I put my loan payment into that business? And is it still going to be profitable, or is it just going to be skating by? It is good when you have an existing business that you're buying, because hopefully you can see the financials. Troy, does everybody show their financials?
Come on, you know the answer to that. No, they don't. And I would say if you're in a position where you're considering purchasing a business and you cannot get financials, then I would consider looking for another venture to pursue. The reason for that is because lenders are going to base their decision on what they see, what's been reported. When I grew up, everybody hid money under the mattress. You can't do that anymore. You had 2 sets of books. I mean, I had thin, but back in the day, everything was a cash society, but it's not the case anymore. So you want to show everything. From a lender standpoint, if they don't see it, they can't analyze it. So obtaining the financials and maintaining your own financials is key. If you don't know how to do that, work with your accountant, work with the SBDC, make sure that you know your numbers, your books are straight. Because that's one of the things you want to have in line when you step up and reach out to one of these folks and you're looking to request funding. It's the first thing they're going to ask you. Let's see your financials. Let's see what's going on. As Leo mentioned, cash flow is king. At the SBA, one of the things that we do well and why lenders come to us is we mitigate shortfalls on the traditional lending landscape. Now, what might those shortfalls be? Collateral is one. Banks are cash flow and collateral lenders. They want to make sure you have the cash flow to repay the loan, and they want to make sure they have a second way out, which is if the loan should default, they can take the business assets or whatever you pledged, liquidate, and make themselves whole as much as possible. At the SBA, we encourage lenders to make loans if there is a collateral shortfall. That's one of the reasons why we encourage them to do the loans that we provide the guarantee. Other things are startup businesses, not enough experience. There's a myriad of things that the SBA program can afford potential borrowers to get them to the finish line of getting the capital that they're seeking. So a little long-winded,
That's all right.
went off tangent.
It's important to note that the reason, you're saying the reason banks use the SBA program is because it has guidelines and they do have parameters
Right.
that all the banks have to follow
Right.
to be able to get that guarantee, which is an insurance policy that the bank gets, right? Like he said, the bank is giving the money, but they feel more comfortable because they know the guarantee. If you default, the SBA will pay 75 to 85% of that loan amount to the bank, but then you owe the SBA. That's important. You're not walking away from it when you default. But it makes the bank feel more comfortable because truthfully, back in the day, I guess, banks didn't want to do any loans. And that's why the SBA came forward. They wanted to do the big guys, they wanted to do where it's much easier and there's more fallback. So the SBA came along for that reason, to give small businesses a chance to get the funding they need to build. Because let's face it, I don't know how much of our economy is based on small business, but it's pretty high, right? It's 85% or something. So that's why we all need to support our small businesses. So I'm just gonna make that little statement, but thank you, Troy. And the SBA is going through some things too, right? You have a new administrator, I guess, and some new policy changes have come through. Did you want to comment about that since I have you on the hook right here?
Sure. Change is a constant in anything. We are going through a lot of changes at the Small Business Administration. I think a lot of them are positive in terms of revamping our underwriting standards, our policies that the lenders are required to follow. A lot of the stuff won't apply to you. It will make its way to you, but in the fashion of when you're speaking with a lender, this is what I need to review your loan. They're trying to follow their own internal policies and also adhere to the guidelines that we set forth. We have had some changes. One of them is the fee structure. I tell folks if you're able to get a loan traditionally, then do that. That's what the lenders want to do anyway. If they find that it's not meeting everything that they need, then they're going to do a second look and say, hey, can we do this SBA? The SBA comes with fees. That's how we sustain the program. So there are fees called upfront or guarantee fees, which basically is a percentage of the guaranteed portion of the loan, depending on the size of the loan. So up to 150,000, it's 2% of the guaranteed portion. Above that, it's 3%, and it's got a sliding scale that way, but your lender can fill you in on that, so you can roll in the fees into the loan, which is great. So the SBA tries to make it as easy as possible, and lenders don't laugh at what I just said, but easy as possible to get you the financing you need. I will say that one of the questions I saw on the list, and then I'm gonna wrap it, was how long does it take to get an SBA loan? Well, a lot of that really is dependent upon you, the borrower. Are you providing the lender with everything they need? In my experience as a lender, I was always chasing folks around for stuff. I need this. I give them a list. This is what we need. Okay, I would get 3 things, and then the other 7 were missing. And then by the time I got what I needed, the first things they gave me were outdated, and then it was a constant. So if your lender asks you for 5 things, get them the 5 things. That's going to push you to the front of the line. If not, you go to the bottom of the pile. They want a decision alone pretty quickly. SBA Express loans get decisions very, very rapidly. You can get your funding, very fast. 7(a) loans and 504s take a little more time, but a lot of it really depends on how quickly you can generate what they're looking.
Yeah, so I just want to add to Troy's comment there. Also, just want to demystify, some of you might think that an SBA loan might take a year to get approved and funded. I would say pretty rare. I could tell you from experience, I did a microloan, the smallest SBA loan, to a physical therapy practice. And from application to approval to funding, it took about a little over a week. So it's quick, right? So as Troy mentioned, I think one of the steps that we can control as applicants is, hey, if the lender is requesting certain documents, the sooner you provide, the better. they'll get things moving along. And also that's usually I tell business applicants that that's a good sign. If the lender's asking for documents, that shows that they're interested. They want to make things good, right? Because yes, it's creating the lenders more work, but they are trying to make it work, right? So everyone wins at the end. So just keep that in mind.
And, oh, okay, go ahead. No, I was just gonna say, and that is also, you only have one chance to make a first impression, right? So when you go in and you've already missed a lot of your documents and the underwriter has to keep reaching out and getting an explanation, and you start to give them pushback. Remember, this is a person who's investing in your business. I think we forget that lenders aren't just lenders, they're partnering in your business. Your success is very important to them. They just want to get paid back. So they want somebody that they can work with. So if you start saying, well, I don't have that, or I didn't file, and it starts to give this impression that this isn't a person that I can really count on to get me what I need when I need it. And that's going to make them nervous. And lenders are very sensitive to that kind of feeling about an applicant. So the best thing you can do is get yourself ready, just like when you go for a mortgage and they ask you for, all your tax returns, personal financial statement, whatever they want, take the time to give that right up front. That's very important. I'm sorry, you go ahead. No, go ahead. Please.
So, on Troy, on the question, if I understand correctly, you would prefer directly go to traditional lenders, not go through SBA. Because it's expensive going through you guys, like more interest.
No, look, well, let me clarify that. You're gonna go to a lender of your choice regardless. They're the ones, as I stated earlier, who are gonna be cutting the check for the loan. What I meant by that statement was that so the SBA is really there as a means to help businesses who don't qualify traditional. So if you go and you speak with M&T Bank and your loan request, and they look at it and they say, yeah, we'll approve you. There's no need to go through the SBA. It's going to be more cost effective. If they look at your application, they realize you don't have enough collateral, but we'll look to do the loan as a 7A loan. Now they get the guarantee from us to mitigate the collateral shortfall. You're still getting the funding, but you're going through an SBA loan. So
Very high interest on that.
no, the interest rates, no, I wouldn't say the interest rates, are gonna be that much different. So you have a guarantee fee, a little more paperwork to do. But when you're working with one of the seasoned lenders up here, they know how to help you get through that process. So, believe me, they're gonna look first to see if they can do it under their own guidelines. And if they can't, then they're gonna say, listen, we can do this as a 7A loan. And then you go down that route.
It's also called conventional loans, right?
Conventional.
Yeah, conventional.
Further answer.
You have a question?
Yeah, I do, if it's okay. I know you had mentioned cash flow as, one of the items that's reviewed, obviously. If you're expanding on a business, right, and you're trying to scale, and the issue is the cash flow, right? You've got to place orders, fulfill, but you need the cash to actually pay for that product. That's where the rub is, right, in that situation. So how do you kind of assess those scenarios? So you have an established business, you see growth over 3 years, 4 years, there's definitely demand for the item. There's ability to expand distribution and what have you. But the issue for a small business is having enough of the cash to place, inventory orders while also selling.
Yeah, well, yeah, thanks for sharing. I would say cash flow in terms of overall, when we look at the tax return, that's a whole year, 12 months.
Mhm.
So, we can get a pretty good sense of the business's cash flow. Now, to your point about, there are some, let's say, temporary cash flow squeezes. Let's say you need to order additional inventory to gear up for the holiday season, right? So that's something that's a legitimate request for sure, right? Because you need it, right? Because you need to upfront the inventory, and in order to procure the inventory, you need some capital, right? So in fact, we've actually done a number of these loans for those reasons, because at the end of the day, your business is going to be cash flow profitable, right? It's just that in temporary period, you need the funds to purchase more inventory to gear up for a busy season. So what I mean about cash flow is if, let's say, historically in the last 3 years, if a business is, let's say, becoming less and less profitable, right? That puts more of a strain on the business over time. And that makes it a tougher proposition for the underwriters to feel comfortable and get that approval over. But in your case, this is a pretty common reason, I would say.
Yeah, and there are different reasons why people have different types of loans. You're talking about a line of credit. Donna, can you talk a little bit about what a line of credit would be? and
Yeah,
what it sounds
we
like?
actually don't do lines of credits at Lendistry, we do term loans, but to piggyback on your question a little bit more, we would look at, if it's an expansion, we will look at the historicals, but we will also try to get an idea of your projections. So what would this inventory do for the business? How do you project it will increase your revenues for the next 3 years? And that's when we would maybe do a combination and look at it both historical and projection based to see, how we can qualify you for that loan to improve your business. So, but we don't, at the current time, Lendistry, that's not really our sweet spot as far as lines of credits.
I'll go turn it to Michelle. I know she has lines. Yes.
So we could do, a line of credit for an established business. So if we would look at your last 2 years of tax returns and your year-to-date numbers. So if you're, say, 2024, your business was $500,000 in gross revenues, we can go up to 10% on a line of credit. So we could then offer you a $50,000 line. Obviously, we have to go through the approval process, but that's something that we would suggest. We always go 10%. So, and that can be used for short-term working capital. For seasonal, if you're a seasonal business or you're just looking to purchase inventory, cover payroll expenses. If it's an expansion, then that's where we look at projections. So say you have a business, you want to buy another business and consolidate the two. Then we look at it as an expansion that we put in immediately as an SBA, and we reach out to our trusted advisors here for the assistance on the business plan.
So that is definitely going to be shifted over to an SBA when
If
in
it's
that
an
scenario.
So yes, if it's an expansion, but if it's just to cover like inventory, we can look at it conventionally
Of course,
first.
yeah.
And we'll look at it and we'll give you our advice. And then, if we think it's something that you have tremendous growth opportunity, there's an opportunity there for you to do something, you're gonna need more than that, say 50,000, then we would look at the SBA, the alternative. But we handle everything in-house. So we handle everything from start to finish. From the application, we then revert over to one of the advisors here at SBDC to assist us with the business plan projections. And then we take the application back and we run it through underwriting. And then we handle it all the way through closing. And we manage the relationship throughout, your time with us.
Thank you.
And some of these, it should be noted that, M&T is a full service bank, right? So you can have your business banking there, you can have your cash management needs filled and merchant service process and all of that. Whereas the online lenders may not require that or have that ability. So you could get a loan from Lendistry and have your banking relationship at M&T or any bank. So, that's something to consider also. I used to be a lender. I always liked my own clients, meaning if I worked at Chase and they banked at Chase and they had money at Chase, it's always a good story to tell. And they tend to want to go in the full with you. That's why you should always go to your bank first, but know that there are options out there as well. Rich, I'm sorry.
To further Michelle's
Yeah.
point, traditional lines of credit through banks, as you mentioned, they want to see a minimum of 2 years of business, and they'll look at usually 10%. Some banks will look a little bit more, 10 to 15%. However, with the SBA guaranteed line of credit, which is what is still up to 350,
So the express line.
the express line, they will look at more. They won't look at 10% of your revenues. They're looking for more. So if you really need 100 or 150, there's a very good possibility that you can get a line that amount. And rates on lines of credit, where are they in?
Well, it's gonna be prime plus.
To further answer this gentleman, he had asked about rates before. And I know you didn't specify, SBA guaranteed loans, 7A program, the majority of lenders are trying to charge, maximum they can charge is prime +3, most of them charge prime +2 3/4.
What is
Prime right now is 7.5%.
Oh.
So there is also there's another program under the SBA umbrella that is the Community Advantage Loan, where lenders that don't do the 7A because it's a little too risky, but it's sort of like a hybrid of the 7A, they could charge up to prime +6. Okay, but they'll do a loan that nobody else do, and these rates on these loans are variable. So if prime changes, your rate is changed based on the balance of what your loan is at one time.
Thank
Yes, sir.
Yeah, so that's the strategy from our end of looking at things is the cost of the money and the time it takes to get the loan. Are these inversely? What you're saying sounds kind of like you're going after really cheap money, then that's gonna take a more involved application, perhaps longer time than if going after a higher interest loan.
Well, okay, I'm not exactly sure, but if you're going, I would say if you go for a traditional loan first, that should be the faster process. Okay, it depends on the lender, it depends on, like Willa said, how much information you get to them. So it varies from client to client. And it varies from lender to lender. There's a lot of that. It also depends on how much money you're looking for, what your background is, how long you're in business, do you have, what your financials look like. There's a whole myriad of factors. I mean, the average time is talking about before for an SBA. I don't think there is an average time, but you can, if everything goes according to plan, within 60 days from start to finish, you should be able to. I mean, I did a deal for the Nautilus Diner right after Hurricane Sandy, $4.5 million for the lender. We did that deal in 45 days. It's the fastest deal I've ever seen done, and it's probably never happened again. But the client was highly motivated to buy back the diner from receivership from the family, and they were stuck in a hotel in Uniondale because their home was on the South Shore flooded. And lender was a small lender, SBIC, I think, just an individual that had an SBA license, and they did the loan. So it was pretty quick for that. I'm working on deals, just talking to Troy about it. But, I mean, they're going on sometimes 6 months, and it's not because of the SBA. It's because of credit issues that come up, more information that you have to provide. There's myriad of things that can happen. So it's quite varied, but someone should be able to, whoever we talk to should be able to give you the beginning. But there are hurdles that sometimes come up and continuously come up that are unforeseen, even at the onset.
It's actually a good point if I.
Sure.
So talking about a timeline, I have a client that I've been working with for, it seems like an eternity for a startup. And I keep reminding them, it's not the bank, it's not SBA, but it's, they need permits. They're opening a restaurant. So there's the board of zoning, there's the town, the village, then it's inspection. So it's taking a lot longer than we actually closed it, but it took longer than we anticipated because and I think the landlord had also passed away and then the son took over. So there were all these hurdles. But with him from start to finish, and they're opening next month. I'm really excited. I can't wait. And I have another one that I referred to Willa, that's an existing business since the 90s. They're doing expansion. And again, same thing, permits and towns and villages and contractors availability. So there are things that, do take time because we need invoices and we have to submit all that for the SBA approvals, that we need the invoices, and there's equity injection, which we haven't even touched that yet. But there's just so many steps that are needed for certain type of loans. And not all businesses are created equal. So, one business might have excellent collateral and it may not have to go SBA, it could stay conventional. And then there could be another business that has no collateral and it's gonna have to go SBA. So, it's not one size fits all, but, as a traditional bank, we handle really all of that.
I'll add, and I think that's why it's important to have a variety of lenders, because in our case, we don't do a whole lot of loans at industries that require equity injections or construction. So if someone's doing a very streamlined loan where they need equipment, they need working capital fast, we can still offer a 7A product or SBA product and get that closed pretty quickly. Because as a fintech, that's what we think about. It's like, how fast can we get you access to capital and how convenient can we make it for you? So that's what's our sweet spot. We don't.
Yeah, I have a question on that too, because a fintech, everybody knows, is an online lender. Financial technology is what they use. And in their underwriting, a lot of that is, the reason it's expedited is you don't have like people sitting there in a
Yeah.
desk and manually going through everything. So it's going through, there's a new credit score
Mhm.
called an SBSS.
Mhm.
And I know that you use that,
Yes.
right, to determine
Yes.
that. Does everyone, you probably don't know what that means. Okay. So it's through FICO, and
Yeah.
you want to explain?
Yeah, so the SBSS score is actually a requirement from the SBA. There's a minimum through the SBA that we have to make sure that we're supporting when a client comes in, when we review their SBSS score. I believe our minimum now is 170, correct me.
165.
Yeah, well, I'm seeing, so their minimum is 165, our minimum is 170, and so we assess anything under 350,000, we are letting the program's doing the work. They're looking at the guarantors. If you are on the rails and you meet our minimum guidelines, you literally can apply and get a response for an approval the same day. Now, if it's off the rails a little bit, then that's when someone's manually looking at it to see, okay, well, they did hit the SBSS score, they did hit the credit score, maybe the DTI is a little bit off. And then we're able to then manually make a decision, but it's still a quick decision. Typically within that week or the next week. And then after that, the client is in control of the process. They're in control of uploading their documents themselves. They're in control of using, we do some additional, because it's an online provider, we do some additional security checks. So you have to go through those security checks, and then you control the portal. Once we have final approval, you actually go in there and you can add the account that you want us to fund also. The process is done completely online. Of course, you have someone like myself in the event you have questions, but that's how we're able to streamline the process to make it faster. And then anything over 350, that's when I'm looking at it. I'm doing maybe a 1-year cash flow, reviewing the deal, and then manually putting it through underwriting. But we've created our program this way to make sure that we can get capital to folks quickly, because that's always top of mind for us. And then we partner with other banks like M&T. If there's a construction deal that I know I can't do, where I can, give someone a call and say, hey, I have a deal that I can't do, but I think it'll be a really good fit for you. So you'll see a lot of the folks on the panel today will work closely together because everyone has their own sweet spot.
You may remember also that during COVID, that's really when we got to know the fintechs, right? Because a lot of the PPP, and they went through regular banks, but they were so busy that all of a sudden all these online lenders came up. And back in the day, we didn't want to put our information online, right?
Yeah.
Well, that's kind of gone, right? Everybody's shopping online, putting the information online. Who knows where this will take us, but that's a whole nother story. But it has been able to get a lot more fintechs that actually even work with banks. Some of the banks I know that I worked with had a fintech that they were working with to do their smaller loans,
Yeah.
things like that.
I actually have relationships with a lot of banks. We partner, and so if a bank thinks that they have a loan that really doesn't fit their box, as someone else mentioned, then they'll reach out to me and say, well, you guys are a CDFI, which means your criteria is a little bit more relaxed than a bank. How do you feel about this deal? And so we work in conjunction, and at the end of the day, our goal is to get the loan for the client. Especially if Michelle gives me a call, says, I really like this deal, but underwriting doesn't like it, but I'm passionate about it, and I'll take a look at it and see if it fits for industry, and then, then we can get the deal done, hopefully, because our criteria is a little bit more relaxed than traditional banks.
Does that affect your rates, that you're more relaxed?
No,
No.
no, our rates are we compare rates to bank financing, so we don't try to do anything predatory. I know we're gonna talk a little bit about MCAs today, and I know those rates are ridiculously high. We try to steer folks away from that. And so we prefer that they go to you know, some of these fintech lenders versus MCA loans, because the loans are just, and I think they're
Explain what
paid.
an MCA loan is.
They're the merchant credit, cash advances, and so folks get them, they get them fast, which is great, because if you have a payroll problem, an operation problem, and you feel, oh my God, I don't want to wait a month, or people think a month for financing, they'll go to these, you know, merchant cash advances, and they can get funding the same day, but you have to be very careful about the ones that you go to, because sometimes the rate is extremely high and they require weekly payments. Well, what does that do for your cash flow? It may be great for the time, but then if you have to now pay this lender every single week, not every month, that's gonna affect your cash flow. And then when you do come to a traditional lender, we have to figure out, well, oh my gosh, how do we assess this and try to refinance it for them and get them a better rate? It's a little bit more difficult, but I think people always go that way because they find, oh, it's fast, I can get funding in 2 days. You might want to still reach out to your resources to see if they have solutions that are bank pricing, and not more predatory in their pricing.
I was gonna ask Nick too, because I know you do something like
Yeah,
that,
so
right?
we're in that space and I agree with you that it is not for everyone. There are situations where someone will require a short-term capital injection for their business. It's a project coming up. It doesn't have to always be an emergency even. It could be an opportunity that comes about with their business, but yes, there is a space for getting an MCA loan. But it's with the idea that there's a bigger exit strategy in mind. It can't, if you want to live in that environment for the rest of your business, it will, you know, tax your cash flow. If not done properly, but that also depends on the people that you deal with. You know, if you're a tag, you know, we have opportunities to get people traditional lending. We work with some of the best banks in the country and work nationally on projects every day of the week. But there are situations where people require quick capital and, you know, yes, the daily, the weekly payments do hurt the cash flow in the short term. It is to help them for an expansion project. It is to help them to get a big deal or a big project that they have that they're working on. Needed and obviously puts more cash flow back in their pocket. So if it's to, you know, if it's to live in that world, it may not be the best decision for most business owners. But there is a place for it, for sure.
Sorry, Mike.
I just want to add, to the merchant, the MCA, facilities, the SBA used to consider these for, refinance. That is no longer an option. So if you do have MCA debt on books and you're looking to do an SBA refinance, that cannot be included. The reason for that is because what we found is that not only are you know, businesses that are utilizing these facilities, it's often a symptom of a more serious problem. And a lot of the refinances that were done at the SBA of these credits were done, and then the business goes and just gets back into that whirlpool again. And you're swimming against the tide unless you have an exit strategy as was stated. So no longer will the SBA look to refinance those type of credits. So just keep that in mind.
Rich, go ahead.
I've done some MCAs over the years, and the important thing is for the client to know what they're getting involved in. Read the fine print. Whoever you're talking to, make sure you know the terms of the agreement. And that's what's important. I mean, businesses that I remember, a couple of them, I did it for cash businesses. So they had the money, but they weren't showing it, so they couldn't go to a bank, get them financing. And to pay, you know, to borrow $50,000 for 6 months and pay back $60,000 made sense to them. Because you know what? It's cash business. They're not paying it to the IRS like they should if they reported it. So they got to pay it to somebody. You know, another business was in the process of getting a very large asset-based line of credit, and they needed $250,000 to help cash flow until that line of credit I finished with them. And you know, that made sense to them too. But they knew what they were getting in from. The problem with MCAs that got bad raps was these predatory lenders that, you know, have boiler rooms with people calling all the Main Street business all the time, but the poor person on the other line that's strapped for cash and needs it and takes it without reading the fine print, they're the ones that get in trouble.
I also just want to add, what's good is, there's a number of different financing options. I think as a business owner, future possible applicant is just to stay informed, right? Well, there's a great resource. She knows different lenders, different types of lending solutions that are available. And I think once you have more than one option to compare it to, gives you more relativity, gives you more insight. You don't want to be caught off guard and take the first unsolicited, financing offer you get from someone calling out of the blue, right? That's most likely not serving in your best interest. I know personally, I work very well with Rich, Nick in the past. They do look out for your best interest. So, we're all resources you could tap into, and just know that you have something compared to, right? You don't just have one option. And, just like with anything, there's pros and cons. MCA, personally, I'm not a fan, but the pro is quick funding, right? The con is the rates may be a little aggressive if we're comparing it to other, let's say, traditional loans, CDFI loans, right? So you want to just be able to see it from a holistic picture, right? The pros and cons of it, and then make your best assessment.
Must be a good fit. I had a restaurant that was opening a second location and he didn't have enough time in the first location. So he took an MCA and it came off the top of his credit card receipts, right? So when they just grabbed the money every, yes. But it worked for him because he was successful. He was able to get the second location going. I don't recommend it that way, but it brings me to another point that we really haven't talked about, which is your financial literacy and keeping your own personal credit in good condition. Because a lot of these, credit is really a behavior, it's a habit. And it starts very young, from the time we're young, and we need more financial literacy in the schools to really teach kids, what is this? I'm taking money, I have to pay it back. Can I do that? And that's really what lenders do for you, is they're doing the due diligence and they're helping you see, is this something that you can really afford to do? And if they say no, I always say to people that, you learn a lot from failure. So go back and think about, why are they declining me? But most important, back to that personal credit, and I'll ask the panel to comment on it, because each lender has a different appetite for the minimum score. But you personally, I want you to take ownership of that personal credit, because it holds you back in so many ways now. Everything is online. The SBSS score is a new score from FICO that is a combination of your personal and your business, if you have a business, your industry, the type of business, all of this kind of stuff gets melded into this algorithm and gives you a score. So it's becoming more and more important as we live online and our information is so accessible. So they're pulling this, and all the lenders are using it outside of just your personal credit score or business credit score. It's now this blended thing. So you are what you pay and how you pay is very, very important. Yes, Anthony.
The SPSF,
SBSS.
SS. Is that something that you have to apply for? Or
No, it's not. It's really just the lenders that have access to that. You cannot get it. I don't know that lenders really share that with their applicants. I don't know. Do you know?
I don't believe so. it stands for Small Business Scoring
Service.
Service.
Mhm.
Thanks, Willa.
Mhm.
It's basically something that the lenders rely on, and that the SBA looks for determining if a credit's gonna get, moved along. For SBA, our minimum SBSS score is 165. It goes from a range of 0 to 300. It's done by FICO. It's a blend of your personal and your business credit, in addition to other risk factors that they're gonna consider. For us, if on an SBA small loan, which is 350 and under, if your SBSS score is 165 or better, then we consider that okay for the lender to move forward. We just ask them to do a credit memo, and they're gonna do whatever they need to as well. But if you pass the SBSS on SBA small loan, then you pretty much get green lights from us to move forward, but remember, the lender's the one who's writing the check. They may have other things that they want to get comfortable with.
I was just curious to find out, is there a way to find out what those points are? So that you.
The lenders don't even know.
Okay.
None that I've told to.
No.
It's just that it's a
No.
score that's spit out.
What I do know, and you mentioned it, is the better your personal score, the better that score would be.
Yeah, that's a big part of it.
Yeah.
You as a founder, you as,
I'm sorry,
you as a founder, but as a person.
of the guarantor, yeah, of the person.
And different industries, you know, like restaurants have traditionally been harder to finance than others. Why do you think that is? Anybody have an idea of why some industries might be harder?
They fail.
They fail, they have a higher
Higher
default
failure
rate.
yeah.
A lot of restaurants close and reopen, you know, with another name and all this kind of stuff. As we call it in our industry, fotsy tootsie goes on and lots of money under the table and things like that. Not maybe it's true anymore because we're paying everything by credit cards and that's what's changed the cash-based businesses that are
Yeah.
out there. They're slowly folding and everybody's getting credit cards, which is trackable, right? You can't lie about that revenue because you're sharing that with a third party. Nick, you look like you wanted to say something.
You know, I wanted to touch on the fact of what you just mentioned about industry risk. That really does come into play on a lot of what we're talking about up
Yeah.
here. It's the industry and it's the health and the healthiness and of the financials of a company. For instance, we have outlets like Pursuit where we can bring, and get more traditional products, SBAs, things of that nature. I'm working with a debt collection company who does $30 million a year and brings 3 million to the bottom line. And on most of my outlets, my traditional outlets, immediately when they find out it's debt collection, they want nothing to do with it. It goes into the algorithm, spits it out with an immediate decline. So there are situations where you do have to find alternative financing. It doesn't have to be an MCA. That is one of the options. But it does not have to end up being an FCA. There are plenty of alternative products that we offer and others, probably Rich offers as well, that are not going to be a very high factor rate, interest rate, however you want to call it, on your money. But it'll give you an opportunity. It'll give this person who does $30 million in an industry that is not looked at favorably, gives him an opportunity to grow. And that's what we're looking for out of all of this. At the end of the day, we want businesses to grow. And how they can do that is going to be contingent upon the person who's looking at the file and the relationships that we have with alternative lenders and, relationships with banks to get that done for them. So I just wanted to add to
And
that.
there's
It's a very
also
good point on
specialty
it.
financing, which some of the bigger banks don't do, like for instance, marinas and hotels, and these are kind of businesses that have different nuances. I know when I worked at Chase, they didn't do marinas, and not on the small scale, and it was because they said it's not really land, it's not really, and all the boats kind of can just go. I was like, okay, but somebody does it, right?
Yeah.
Someone does it. The bigger banks, with the exception of M&T, honestly, because you're very open to, I remember back in the day in the recession, they were the only player out there that was actually taking a chance on small businesses. Like 20 years ago, 2009, big recession, nobody was out there doing it. I went to, at the time it was NYBDC, and I had a restaurant wanting to buy the building, and they said, you gotta go to M&T, and they did the deal. Nobody else would do it. So that sticks with me. But some of the bigger banks do have so much coming at them that they can afford to be choosing. That's why you need to know that there are options, right? It's not that there's anything wrong with you or your business. It's just they have a portfolio that they look at and they say, okay, which of my industries is this comprised of? And do I have too many restaurants? Okay, let's hold off on the restaurants for a while. Let's, if it was your own portfolio, you'd want to manage your risk across the portfolio by having a diverse section of every industry, or maybe some that you have had a high default rate with, you're not going to do them. And so there's a lot of things that go into appetite, is what we call it. That's why we try to stay close to what they're looking for. Who's got the appetite for this? A lot of times I will say that to them, do you have an appetite for doing a marina? And no, but I know someone that could. Nick, do you do marinas?
Yeah, absolutely.
You do those
Yeah.
kind of things? Anybody else?
Well, yeah, we'll look at it.
You'll look
too.
at that? Okay,
We
good.
didn't do marinas, but we do tons of hotels. And I know that's
Okay.
something that.
Yeah,
my previous
And I know you
employer-
do investment property, which a lot
So
of people don't do.
investment, Real
Right.
estate, yeah.
Mhm. Could you tell us a little about the criteria for an investment? Because that's not SBA.
Yeah,
SBA,
investment real estate, I tell people all the time, the most important thing, if you're looking to purchase a piece of investment property, is that rent roll. Who are you, who is the current landlord leasing to? How are they paying? How long are the leases? We look at the NOI, and that's how we assess if we're gonna be able to do it. I tell people all the time, we're gonna prefer 3 tenants over one, because one tenant is just gonna be very risky, because if that person moves out, then how's the landlord gonna pay, the mortgage? And so, there's many factors that we look at, but that rent roll is the most important. You wanna see what type of businesses are they're leasing to, how they're paying, how long are their leases, because then we can really assess, well, I looked at one in Connecticut, and all of their tenants have been there for 20+ years. However, the landlord who is looking to sell it only had 2 leases in place, and there was 10 folks there. So now I have to fight to figure out like how we're gonna get leases in place, because technically there is no legal lease in place for 8 of the tenants. And so that's a little risky for us, but then we're gonna work with the client to figure out like, how do we get leases in place for these folks who've been there for 20 years? Some of them are larger companies that are corporate that we might not be able to get a hold of or get a lease done quickly. But to me, it sounds great. But to my underwriter, I have to come with some leases in order to justify doing a loan for a 10-unit strip mall that only has 2 leases in place. So.
Yeah, I have programs that are similar to that for traditional, but there's also DSCR loans that service coverage ratio. Don't have to be any tenants in place, don't have to be any leases in place. It's for investment homes for 1 to 4 families. They will finance 70% of the property. If it's a fix and flip transaction, they'll finance 70% of the purchase price and 90% of the construction costs. Loans are approved in a week. They close within a couple of weeks later. If there's on the construction part, it's very favorable, because unlike a bank, you have to go out and do physical inspections that cost about $500-600 every time there's an inspection. There are multiple ones. The lender has an app they give you on your phone. Take a picture of the work that's been completed. It matches up with the schedule that the contractor gave you, for that, like the foundation being poured, or the house to be studded, whatever. And next day it's in your account. Rates are reasonable. They're in the single digits. It varies from project to project. And for the investment properties, I've done 30-year fix in the 6s, which I was actually very surprised
Pretty
on.
good for investment.
How is that on with newer clients, like someone new to that particular industry? Is still favorable?
Yeah, they don't need to have, a seasoned investor. Want to do it yourself first time?
No, we have people, we all have
I'm just
people,
saying.
and it's not something we do, so that's great. Love to
Right.
send them your way.
Okay, okay, we have some questions. Go ahead.
Got a couple of questions. One is, what's the typical payback period for a business loan? 5 years, 10 years?
And it's gonna be dependent upon the loan need. If it's a real estate transaction, obviously you can go out as far as, 25 years on that. If it's a business acquisition, I'm speaking from SBA, go out as far as 10 years. Equipment, it's gonna be matched, you wanna match it to the useful life of the equipment, so it really depends on the need, which, I think is important for everyone to understand. The last thing you wanna do is to approach anyone on this panel and say, I need $100,000, and the first question you're gonna be asked is, what do you need it for? And if you can't answer and justify it, it's not gonna work out too well for you. Back in the day, prior to the meltdown in 08, 09, lenders were giving out lines of credit like they were giving out candy for Halloween. Didn't care. Those days are over. So, and as a business owner, you want to be prudent with your funds. So you want to know if you're approaching any of the lenders for a loan of $100,000, you want to be able to itemize, say, well, I'm going to use 50,000 for this new machinery. I need 25 for working cap, whatever it may be, leasehold improvements. It's something the lenders refer to as sources and use, source of the funds and how you're going to use them. So that's a big thing. So keep that in mind, and they're going to look to fit it into a term that's appropriate for you. You can prepay it, ask about prepayment penalties. On the SBA side, as long as the term is less than 15 years, you can pay it off early if you like.
And if you do get a loan, let's say you get a $2 million loan, you don't need it immediately. You need it over a 2-year period. Do you have a graduated disbursement for that loan?
Well, I'll let them call it the lenders. First of all, $2 million, no one's gonna give you for 2 years. If it is an SBA guaranteed loan, like Troy said, it's under 15 years, no repayment penalties. So it has to, your cash flow has to be able to support the repayment of the monthly payments. So on a 2-year period, it's probably gonna be astronomical. Probably wouldn't have the cash flow, but on a 15-year or 25-year period.
No, 2 years to receive the money, the payback period.
So you're looking for the money in tranches?
Yeah.
Yeah, a lot of people do that. It's part of, you know, when someone says, oh, I want $100,000. Okay, what are you using it for? The reason we ask, not only is we want to have good use of funds, but we want to know that there's an opportunity. We want to know if there's an opportunity to say, I only need 50 now, and I want the other 50 in 8 months from now. So you're not paying interest on that immediately.
Yeah.
That's where a line of credit may come into play. There are products for that, to help to alleviate pain, unnecessary interest.
Yeah, it's more a question of expansion, right?
Right.
You need,
So you need like a landing.
well, to hire more people, to get the payroll up, while you're developing a product that may take a year and a half. You know, start selling, right? New product, because you already have a business product. But if you want to invest in a new product, that's gonna take a year and a half to 2 years.
If you're looking for R&D money,
What's that?
you're looking for our research and development money.
Basically.
You have a line of credit now,
Internally, yes. It's
not
one of
from a
my,
bank.
no, one of my partners, sold his business for $1 billion, so.
Right, so if you're able to qualify for a bank line of credit, that might be a start right there. And that can get you to the next stage, but then, you know, you could, with some lenders, potentially get approved for, you know, let's say the maximum amount that you need. There may be a way to take it down in stages, but, you know, big stages, $500,000 at a time, so.
What I don't wanna do is give up equity, through a VC. They lend you $2 million. and
SBA
1.5%.
doesn't take equity, neither do the players that we're talking to here.
That's why I'm here. I don't wanna go through the VC run.
And we do, at M&T, we do something called a loan limit. So if you qualify for a large amount, we look at the qualification of it. And then, as say you needed, you know, 300,000 to buy a piece of equipment, we would take 300,000 out of that amount and we would turn that out. And like Troy says, the limit, that's all of a sudden, the life of the equipment. So like on equipment, we would do maybe, you know, anywhere between 5 and 10 years. So then we would term out, immediately disperse those funds for that piece of equipment. That's our collateral. We put a UCC lien on that serial number for that specific item. And then you have a loan, and then we can disperse it out over time. So there's, you know, there are options out there. But it's a matter of, does the business qualify for that much money? You know,
If we already have collateral, we own our building, we have assets inside, that'd be the collateral.
Absolutely.
Yeah.
Building thing clear. It's possible to, you know, get a mortgage against the building, hopefully it's out.
we love collateral.
Yeah, everybody loves collateral.
Everybody loves collateral.
It's always about 3 ways out, right? So there's the cash flow, the collateral, and your personal. So if you think of 3 buckets, how filled is each of those? And if they're all really good, you've got your choice of a lot of lenders. If one is kind of deficient with the collateral, like Troy was saying, that's when the SBA program comes in, because it kind of helps boost the lender's feeling about one of those buckets not being as good. Cash flow is the hardest to overcome, but that's where the projections come in and they have to be reasonable. We spend, one of my clients was here today and I spent months doing the projections. We kept going back and forth with his accountant and, we try to get them as accurate as possible so that when they go to the lender, they make sense and they're not just pie in the sky. They've got real numbers behind it. So that's important for you as well, to really look at all the costs. I sit with a lot of clients, and once we go through that sources and uses of funds, okay, you need this much, you're going to put in this much, and let's talk about what you're spending it on. And needless to say, everything costs more than you think it does, right? So that uses gets much bigger than the sources, and that's when you have to cut back and do other things. We're nearing the end. I want to give everybody, you have a question in the back with us? I have 3. Oh, boy. Okay, go. If you can be quick.
Okay, what's the qualities and strengths do you look for in a small business, especially for women-led creative ventures that I'm doing, when you try to approve a loan or credit or a line of credit?
Okay, are you speaking specifically for woman-owned business or just,
Well, just, I guess in general then.
Okay, so we talked about a lot of those, right? Your cash flow, your personal credit,
Business.
time in business, the industry experience. I think that's pretty much most of it. Collateral, again, if you have it. Depends on the loan amount. And these are all like specific things that we could, what I encourage all of you is to reach out to these lenders and talk one-on-one with them about what you're looking for. I think we gave a pretty good variety here of different types of options, and you always can come through us and we'll try to help you navigate through all of that. We don't have a lot of time, but I want to just go quickly. One thing we didn't talk about is the economy and all of that, because that's the uncertainty of the economy does impact also risk appetite. When things are exploding all over the world, you see it in the stock market, goes up, goes down. That's not good for lending because it gets people very nervous. However, there's always an appetite for a good loan. And if I go through the table, what would be your strategy for someone trying to purchase or trying to get business financing at this time in this economy? I'll start with Leo.
Sure. I would say start early, have time on your side. I can tell you, Pursuit is always, Pursuit is fortunate in that it's always in a very opportunistic situation of position to serve. During pandemic, we have a lot of COVID relief loans, even now. Even with the increasing rates, we're relatively speaking pretty competitive because we cap our rates at around 10 and change. So as I mentioned earlier, we have a number of SBA loans up to 5 million, even for commercial real estate, 10% down, right? All the way on the low end, if someone's looking for, let's say, working capital up to 150K, we also offer that. I would say have time on your side, start early, reach out to the lender. If you're not in a position to apply, you could certainly get a lot of good nuggets of wisdom. Well, as I mentioned, good resource. If it's a startup loan, you're going to want to put together a business plan, financial projections. Existing businesses, you don't necessarily need that, but certainly you want to work with a capable accountant, bookkeeper to make sure you have the taxes filed, the interims put together. But that way you're in a very ready position to apply for a loan.
And that's true. If you're an existing business, get your finances in order too. Don't come with years of losses because you wouldn't want to invest in that either. So try to think ahead. And I love that. Put time on your side. That's my one thing. Go ahead, Ladon.
For me, I love to see clients prepared, something about a prepared package, someone who knows what they need, knows what they need it for, understands what it will do for their business, and they can outline that in their projections. They're confidently telling me, here, this is what I know it's going to do. They're coming with market knowledge too. So I like folks that they do their own research on the industry. Hey, LaDonna, I heard that in the next 3 years, this particular industry is going to grow, especially tech, hospitality. They're coming fully prepared, understanding their balance sheet. understanding their P&Ls. Not, I've had some clients that count on their CPAs for that. I always tell people, as a business owner, you need to understand it also. It's extremely important for you to, because then a lender sees that and says, oh, this person knows what they're talking about. They know where they want their business to go. So mine will be prepared.
Yes, and I think that that's a very good point, because in COVID, the first questions we asked is, what's your revenue? And then we go, I don't know, I have to call my account. No,
You need
you
to,
should know. What do you do every year? How much in sales? What's your bottom line? There are certain things that really you need to know, and I suggest that you get involved in the bookkeeping, even if you have a bookkeeper. At the end of every month, look at your P&L. Where did you land? Did you get to where you wanted to be? Are you profitable? Are you losing money? Do you have to make adjustments? If you stay on top of that, it's boring. I know a lot of people hate doing it and they like to just get out. Most entrepreneurs, all entrepreneurs are salespeople,
yeah.
and they don't like to get into the weeds, but there's some basic numbers that you need to keep track of and be on top of.
And COVID showed us to have a plan, an exit
Right.
plan in the event. Just because I know, having a COVID plan was added to, the C's of credit. And so, a lot of
That's
lenders,
disaster strategy. And, you know, if something happens bad, you know, how do you do? We just went through that with our organization, actually. Troy, I have to move quickly.
Yeah. I'm just gonna echo what they said as far as preparation. We learned a lot from COVID as far as having a plan. I would, certainly hope that business owners are going forward, monitoring what's going on, in the economy, what risks may be down the line. We all don't have a crystal ball, but we have indicators that we could look at. With AI and everything coming out, it's very easy to look up information, see what threats may be coming for your specific business. Are you dealing with, most of your clients are just, from disposable income? You have a restaurant. If the economy is showing signs of cracks, how am I gonna get ahead of that? How am I gonna prepare for it? Do I have a line of credit now? Get it when you don't need it. It's like life insurance. Speak with the SBDC. I have to, put a feather in your cap. The most precious resource that you have as a business owner is time. Start with the SBDC. Let them know what it is you're trying to do. They have a good handle. Willa has a great handle on what lenders on this panel will have an appetite for the loan that you want and which ones don't. Don't start with the ones that don't. You're gonna lose time. You're gonna get frustrated. So use the resources available to you, especially in these times. And I think you'll be doing yourself and your business a good service.
So many good points. Yeah, I mean, when you come to us, have an idea of what you're looking for, do your research, we'll help you gather more research. As Troy mentioned, AI, ChatGPT. I love ChatGPT. You can ask ChatGPT anything. You can give your chat a name, you can call him Sam if you want. And every morning, if you have questions, say, hi, Sam, and say, if you have a question about a business, what are some risks involved in this business if you're looking to open one? It'll spit back in 30 seconds. It'll tell you what are the risks about that specific industry. And then you might think, maybe this isn't a business that I want to be involved in. But it gives you such great ideas. We on the banking side, we have other sites that we use, but I love chat. We love a full package. We love a positive net number. A lot of accountants, they might play with numbers so that you're not, paying to Uncle Sam. But positive net numbers is what the bank's looking at, because you have to have the cash flow to cover that debt service or a potential loan. Trying to think what else. And yeah, I mean, M&T, I'm open to look at anything, any type of loan. So if it's hospitality, we will look at hospitality. If it's like a bed and breakfast, we can look at that. If it's buying a larger hotel on the east end of the island, we have someone in our commercial team in middle market that handles that. I think Rob Group is here from Pursuit somewhere, and him and I had a deal a few years ago with someone that wanted to open a bed and breakfast, and it's something we'll look at. We don't do Airbnb financing. That's probably the only thing I will tell you after that we won't do. But someone else here might.
Okay, and Rich,
To Troy's point, get your package in order before you apply with the SBDC, because they know what lenders are looking for. Do not apply to more than one lender when you start. Okay, some people say, well, we only apply to 3 places at the same time. You could be shooting yourself in the foot. The first lender will let you know if they're not interested, what the reasons are, which might be reasons that you can mitigate going to the second lender. Do not apply if you are past due on any of your personal credit accounts. So even if you missed a Macy's bill, $30 last month, make sure that's up to date before you go. If you have a commercial mortgage for your business, same thing. If you've missed a payment in the last 12 months, do not apply. You're not going to get approved. There's no lenders that SBA or not. One thing that is important to know too, talking about revenues and so forth and cash flow, is if your business is in that situation where you're turning the corner, cash flow is getting better, but it's just not quite there. A lot of SBA lenders will do projection-based loans. So you could project out with an SBDC counselor or your CPA or a combination of the two. If you have X number of dollars now in your bank, which you can use it for to make your business grow.
I will add, there was tremendous points made. I will add to the idea that if we're looking at uncertain times economically as a country, best thing a business owner, the 2 best things a business owner do, I think, are keeping cash in the bank, having reserves. When someone looks, when an underwriter looks at the file and they see that there's money in the bank consistently every month, you're not draining it down to 0 and then starting back up. It's really looked at favorably. That's the first thing. Second thing I would recommend is, I think it was actually mentioned, I'm thinking the same thing, Troy. Get a line of credit. Doesn't cost you anything at most banks to or facilities to keep a line of credit open, but get it before you need it. Get it while your business is healthy and shows well and presents well. And that way you have that, you're operating from a position of strength. You have that in your back pocket at a moment's notice. If something happens, if tariffs hurt your business, if you're a trucking company and they had the strikes and now you're sitting there and you have loads of cargo that you can't deliver around the country, have a line of credit in your back pocket in a moment. So you have that safety net at a moment's notice. Those are the 2 biggest things. Keep cash in the bank and get a line of credit.
all excellent points. Thank you very much. Please feel free to connect, take time, or take their card, and thank you all for coming. Thank you. Appreciate it.
Material.
Yeah, you put it.
Yeah. Oh, I thought it was emailed this morning. I said, oh, him.
Yeah, he will be to but,
Spaghetti dust for us?
oh my God. And that's the whole rub, right? It's
Well, you know what?
Next level.
It's funny because I had. And I was gonna do it, but, I went. Don't worry.
Oh, you would have gotten it.
I know.
Yeah, well,
But I love.
Yeah.